As a potential recession might come in the next few months, we are never prepared enough to face an economic drawback. This is especially true when the Fed is raising interest rates, when sales all around the world are dramatically falling, and when the markets are going down. Here is what you need to know. Hi, Jared here, and today let's talk about recessions. So first, we'll see what is a recession, some tips on how to face a recession, then some key data and stuff around, again, recessions. The total value of all goods and services produced in the country during a period of time, also known as gross domestic product or GDP, is the basic measure of how well the economy is doing, basically. When the GDP drops from one quarter to the next, that is known as negative GDP, and it signals an economic downturn. And if there are two back-to-back quarters of negative GDP, this is known as a recession. Other indicators are rising unemployment, negative consumer sentiment, and a pullback in productivity. So here are some tips that I've learned along the way that will probably help us in a recession and in the day-to-day life. First and foremost, having additional income. Because yep, even if you have a great full-time job, it is not a bad idea to have a source of extra income on the side, whether it is some consulting work or selling collectibles on eBay. With job security so non-existent today, more jobs also mean more security. I have learned that diversifying your streams of income is at least as important as diversifying your investment. Once the recession hits, even if you lose one stream of income, you will still have the other one to support you, right? You may not be making as much money as you were before, but every little bit helps. You may even come out to the other end of the recession with a growing new business as the economy turns up. Get ready, because this is a long sentence. For instance, I work in restaurants, I have a job in high school, I try to grow my YouTube channel, I invest in the stock market, from the investing series on YouTube, to have monthly, quarterly and yearly dividends. I own crypto and receive rewards from staking them. I also mine cryptocurrency at the top of that. So yep, this took me years to build and to learn everything I needed in order to start my businesses, but in fact, it is rewarding. Okay, next, diversifying your investments. And if you do not have all of your money in one place, your losses should be mitigated, making it less difficult emotionally to ride out dips in the market. If you own a home and have savings account, you already have a good start. You have some money in real estate and some money in cash. In particular, try to build a portfolio of investment pairs that are not strongly correlated, meaning that when one is up, the other is down, and vice versa, like stocks and bonds, for instance. If you work at American Airlines, you wouldn't probably want to invest in it, because if the company is facing severe economic downturn, you might lose your job and lose your investment value. There are tremendous differences in the way different industries or sectors operate. As investors diversify across industries, they become less likely to be impacted by sector-specific risk. Another example, consider the Chips and Science Act of 2022. This piece of legislation impacts many different industries, though some companies are more impacted than others. Semiconductor manufacturers will be largely impacted, like Nvidia, AMD and Intel, for instance, while the financial services sector might feel smaller residual impacts. That is why you should hold a mix of energy stocks, tech stocks and healthcare stocks, as well as from other industries. And that is not it. You should also consider large cap stock, small cap stocks, dividend stocks, growth stocks, and value stocks. Lastly, you can diversify your portfolio across industries, like said previously, but with investments that may counterbalance different businesses. For example, consider two major means of entertainment: travel and digital streaming. Investors hoping to hedge against the risk of future major pandemic impacts may invest in digital streaming platforms, which are positively impacted by shutdowns. At the same time, investors may consider simultaneously investing in airlines, which is positively impacted by fewer pandemics. And in theory, these two unrelated industries may minimize overall portfolio risk. I have talked a lot about stocks, but you should also consider non-stock diversification options, which include bonds, cryptocurrencies, gold, and real estate. Implementing these financial strategies will not only serve you during shutdowns or economic downturns, but will also serve you no matter what's going on in the markets. Keep in mind that recessions do not last forever. I promise, because if you lose your job or your income changes, you may have to cut back significantly your spending or spend your emergency fund, but you can always recover that later. Since 1900, the average recession lasted about 15 months. A recession cannot be declared until it has already been going on for at least 6 months or at least 2 consecutive quarters of economic decline, as said previously. So keep in mind that if the recession is going on today, it is already half gone. Stock market downturns vary in length, but they are also typically much shorter than periods of growth. From 1926 to 2019, the US market experienced 8 bear markets, which happens when the major market indexes drop 20% or more. And these ranged in length from 6 months to 2.8 years, according to data analysis by First Trust Advisor. And what should you do in a downturn? Well, it is highly difficult to predict when the downturn is going to occur, so the best way to prepare is simply to live by solid financial principles, avoid debt, build savings, invest in the long term. The most successful investors like Warren Buffett tend to view the stock market as an investment in the long term and avoid buying and selling only based on cyclical changes in the economy. Instead, it is wise to have an investment plan and stick to it throughout the ups and downs of the markets. So, trying to time the market only based on economic predictions and luck is something I would not recommend. And in fact, more people lose money on the stock market because they try to time the market when, is the worst idea we could have. So, what are your thoughts about my recession-proof rules? Would you have a few to share too? And what are your thoughts about investing during a recession? Thank you so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and I will see you in the next one.